Well, there's been a lot of talk lately about what's next for silver, and I think most people are staring at the wrong thing because the loudest story right now isn't even about price. It's about pressure. Pressure in the headlines, pressure in the coin shop, pressure in the way people are quietly changing what they're willing to hold. And if you're watching closely, you can feel something shifting, not on a chart in behavior. And that's where the real clues are. Now, quick anchor so we're all on the same page. Today in New York, it's Thursday, February 19th. I don't want to miss this. And when you hear that, you have to ask the next question. Why now? Why this kind of silver? Why that urgency? Because here's the key argument they make in that shop conversation, and it's an important one, even if you don't fully agree with it. They're basically saying if you want the most metal for your money, the old coins are winning right now. Not because they're prettier, not because they're trendy, because the premium math works. Or at least it works better than the shiny stuff in the case. And that's where the whole conversation takes a turn. Because the second you bring up premiums, you're not just talking about spot price anymore. You're talking about stress. You're talking about what people will actually pay when they feel uncertain. And that's why the debate in the shop gets spicy. You've got one side saying silver rounds and government ounces have their own crowd, and they do. Some people only want clean, even, simple, one Oz, two Oz, neat stacks, no thinking. And then you've got another crowd that likes the old stuff, the stuff that's already been money before, the stuff you can break down into smaller pieces without needing a saw. And they bring up something that sounds like a joke but isn't: the math, the arithmetic. Because constitutional silver has its own language. And if you don't speak it, it can feel annoying. But if you do speak it, it feels like you found a back door. And the shop guy basically says it out loud. It's not for everybody. Which is true. And that sentence matters because when something is not for everybody, but it's still selling out, that means the people who do understand it are leaning in hard. And that's why the Mercury dimes become the star of the show. Not because anyone thinks they're magic, because they check a few boxes all at once. They're small, they're familiar, they're easy to count, they're easy to trade in a pinch, and they're psychologically comfortable. A lot of people don't want to picture themselves trying to sell a big bar someday. They want pieces, options, flexibility. So when the shop says the dimes flew out the door, that's not just a cute line, that's a signal. Especially when it's not just dimes, it's quarters too. It's other old silver getting thin. And when inventory gets thin, you start to learn what the market values most. Not what it says it values, what it actually grabs first. Now, there's a moment in the shop where they do something that's honestly brilliant for retention. They make it real. They don't just talk about demand, they buy. They put a budget on the table. They basically go, all right, how far does this get me? And they land on a handful of Mercury dimes for around $100. They treat it like the first sale of the day. They make it personal. They bring in the mother-in-law angle. And yes, that's humor, but it's also social proof because it normalizes the act of buying silver, like it's groceries, like it's fuel, like it's something you just do when the world feels weird. And that's the second big theme that runs through this whole conversation. The world feels weird because every few minutes, they pull you back to geopolitics. They keep bringing up tension between the United States and Iran. They mention military assets moving. They mention a carrier group heading toward the region. They mention negotiation happening, but they don't trust it. They even talk like the diplomacy is just a cover while preparation is happening. And then they make the classic claim, bad news is good news for metals. Now, I'm not here to scare you, and I'm definitely not here to hype conflict, but I am here to point out something about the way people think when headlines get heavy. When people feel uncertain, they don't always run to the thing that has the best return. They run to the thing that feels solid. They run to the thing they believe will still matter if everything else gets shaken. And that's why the scene jumps from carrier groups to coins in the case so easily. Because in the mind of the buyer, it's the same story. A bigger storm might be forming. So I want something tangible. Something I can hold, something I can pass down, something I can use if I ever have to. And that's where they start talking about gold, not as a trade, as insurance. They tell the story of a woman coming in selling jewelry, but holding on to some gold because of advice from her family. The whole thing is basically, my grandfather lived through war. He said gold mattered. And you can roll your eyes at that if you want, but you shouldn't dismiss it because those stories are how normal people make decisions. They don't look at a spreadsheet. They look at survival memories. And when enough people start thinking that way at the same time, behavior changes. So now you've got this layered setup. Retail demand for small silver is hot. Geopolitical tension is acting like a spark in the background. And price is pulled back from higher levels, which changes psychology. Because here's the part that gets tricky. In that shop conversation, they're framing a pullback as a gift. Like, hey, you missed the run and now you get a second chance. And I get it. That framing is seductive. It makes people feel smart for buying a dip. It makes people feel like they're correcting a past regret. But here's my counterpoint. Sometimes a pullback is a gift, and sometimes a pullback is a warning. And the difference is not the price. The difference is the reason. If the reason the price fell is purely emotional, like panic, leverage, forced selling, then yeah, a pullback can become a gift. But if the reason the price fell is that demand is weakening or liquidity is drying up or the macro environment is shifting against it, then a pullback can become a trap. So don't just buy because it's lower than it was. Buy because the story under it still makes sense. And that shop chat gives us a clue almost accidentally. They talk about buyers and sellers. They talk about traffic. They talk about green days. They say when prices tick up even a little, people rush in to sell. That is a real thing. When people see green, they feel relief. They think, finally, I can get out. And the dealer sees a flood. That tells you something important. It tells you there's still a big chunk of people who are not long-term holders. They're opportunists. They're flippers. They're people who bought and then got scared, and they're looking for the first exit ramp. So if you want a sustained move higher in silver, you eventually want that behavior to change. You want people to stop treating every bounce like an escape. Because if every bounce triggers a wall of selling, price can struggle, even if the long-term story is strong. Now, the scene also mentions something else. A day where there was a line outside before the shop even opened, and they weren't just buying, some were selling too. That's another clue, because it tells you the market is two-sided. It's not a one-way stampede, and two-sided markets can be healthy. They can also be unstable. It depends on who has the urgency. If sellers are urgent, that's different than buyers being urgent. If buyers are urgent, that's different than sellers being urgent. And the shop guy says it's been a balance. Steady, busy, but not insane like it was during a previous spike. That's basically describing a market that's cooling from a frenzy. Which brings us to the idea they keep repeating: a base, a floor, coiling, whatever word you like. They're saying silver might be building a new resting place at higher levels than people used to expect, and they use anchoring psychology to explain it. If you saw prices way higher not long ago, then today feels cheaper, even if today would have sounded crazy a year ago. That's how the human brain works. We don't judge price in a vacuum. We judge it compared to what we recently saw. So yes, a move down from north of 100 to somewhere in the mid-range can make people feel like they're getting a deal, and that alone can drive retail demand back up. But again, that doesn't guarantee the next leg higher. It just means the psychology is primed. Now, there's also a product promo, a new 5/0's maple leaf coin from a national mint, pitched as a first-of-its-kind, sold exclusively through one dealer. I'm not going to tell you to buy it, but I am going to tell you what it represents. Because when you see heavier formats and flashy exclusives pushed hard, it usually means one of two things. Either demand is strong and they're trying to feed it, or demand is choppy and they're trying to manufacture urgency. Sometimes it's both. Either way, it's marketing adapting to attention, and attention is the scarce resource now. Everyone has a chart, everyone has a take. So the market tries to create events, and that's why the shop conversation keeps bouncing between product hype, geopolitical risk, and real inventory, because it's all part of the same ecosystem. Fear creates attention. Attention creates buying. Buying creates scarcity. Scarcity creates more fear. And around we go. Now let's talk about the metal debate, because this is where people get emotional. They don't just ask what's safe, they ask what's going to win. And in that shop, they bring up the big three: gold, silver, platinum, and they basically ask which one does best this year. One guy immediately says silver. He says silver has the most movement, and that's a real point. Silver is volatile. It's the one that can make you feel like a genius and then make you feel like an idiot all in the same month. That volatility is why people love it, and it's why people hate it. Then the other guy throws out platinum as the sleeper, and I'll give him credit. Platinum does get ignored. People don't talk about it as much. It's not as common in a retail case. It doesn't get the same cultural hype. And yet, it can move hard when conditions line up. And there's another interesting detail in that shop scene. They look in the display, and platinum simply isn't there. That matters because it shows you how retail actually works. Some metals are order only. They're not stocked the same way. They're not flipping hands the same way. So, if you're thinking about platinum, you have to think about liquidity, spreads, availability, how easy it is to get in and how easy it is to get out. Could platinum outperform? Absolutely. But sleeper can also mean you might not like the ride. And I want to keep it real with you. Sometimes people pick a metal because it sounds contrarian, because it makes them feel early. But being early is not the same as being right. Now here's where I add some fresh context most people miss, because this is the part that decides whether a dip becomes a base. Silver is not just a fear asset, it's also a wiring asset, a connectivity asset, a make electricity behave asset. And one of the biggest real-world bottlenecks in the United States right now is power. Not ideas, power, grid capacity, interconnection delays, local resistance, lead times. You can hear it across recent market updates. Data centers want to expand, but the limiting factor is often the ability to get reliable electricity where they need it. So, what happens next? Spending shifts toward infrastructure, transformers, switchgear, cabling, efficiency, backup, and every one of those categories has materials demand embedded in it. That doesn't mean silver instantly doubles tomorrow. It means there's a steady structural pull that didn't exist at this scale when people only thought of silver as money. Solar is another one. Even with efficiency improvements, the sheer pace of installations keeps solar as a meaningful driver of industrial demand. So, when someone tells you silver only moves on war news, that's incomplete. War news can light the match, but the woodpile is bigger. Now, gold is different. Gold is more like a confidence gauge. It's less about industry and more about trust. And if you've been paying attention to how governments and institutions behave, you've probably noticed something. When confidence wobbles, gold quietly gets treated like a reserve, like ballast. Based on recent publicly available reserve summaries, official buying has stayed meaningful even as the pace shifts around. That matters because it changes the baseline of demand. It creates a background bid, and that can alter how gold reacts to shocks. So when the shop guys toss out big price targets for gold and then say silver could follow, I get why they say it. But targets can distract you from the real driver. The driver is confidence. The driver is currency trust. The driver is whether people believe the system is stable. And that brings us back to geopolitics. Which brings us back to the Iran tension narrative, because the argument is simple. If things escalate, metals can rip very quickly. They even mention evacuation talk. They mention people being told to leave. They mention a help is on the way type statement. And the whole vibe is something is coming. Now let me be careful here. There's a difference between acknowledging risk and building your entire plan around the most dramatic outcome. Markets punish drama because headlines come in waves, and the first wave is usually messy. Sometimes the first reaction is metals popping. Sometimes the first reaction is everything selling because people need cash. Sometimes the dollar spikes first. Sometimes yields jump. Sometimes the market doesn't behave the way the story says it should. So if you're positioning into uncertainty, don't do it like a gambler. Do it like an adult. Size it so you can hold it. Buy it so you don't need it to move tomorrow to feel okay. And don't let one carrier group headline become your entire thesis, because that's how people get trapped. They buy the spike, they feel smart, then the spike fades, and they feel betrayed. But nothing betrayed them. They just mistook a headline pop for a trend. Now, to be fair, the shop conversation does one thing that I respect. They don't just push doom. They talk about long-term prudence. They talk about holding metals for decades. They talk about passing it down. They talk about teaching their kids. And that's a healthier way to think about it. Because if you treat metals like a generational hedge, you stop obsessing over whether it's up next week. You start caring more about accumulation habits. You start caring more about buying intelligently. You start caring more about not panicking. And in that mindset, a pullback really can be useful, not because you're chasing a target, because you're building a position slowly. Now, there's one more event plug, a Long Beach coin show running from the 18th through the 20th. They'll be set up at table 723, a booth or two from a grading service, buying and selling all weekend. If you're nearby, stop in and say hi. And I'm bringing that up because coin shows are an underrated signal. They tell you where real demand is. They tell you what dealers are struggling to keep in stock. They tell you what people are selling when they feel pressure. They tell you whether the crowd is cautious or excited. A chart can't tell you that. A crowd can. Now, before we wrap, we have to address the human story part because that segment leans on it pretty hard. They tell the war story. They tell the Venezuela story. They tell the gold saves your life story. They even use that dramatic last helicopter out metaphor. And I understand why those stories stick. They create emotion. They create urgency. But here's the honest take. You don't need the world to end for metals to matter. You don't need catastrophe for hedging to be rational. Sometimes metals are simply a way to diversify away from policy risk, inflation risk, currency risk, debt risk, the kind of slow risks that don't trend on social media but still change lives over time. So if you're stacking, don't do it from panic. Do it from principle. Do it because you want part of your wealth outside the system. Do it because you want something that isn't someone else's promise. And if you're successful, share your success story in the comments so others can stay motivated. Now let's land this plane. The biggest takeaway from that shop conversation isn't a price prediction. It's the behavior. Small silver moving fast, constitutional getting thin, people trying to stretch budgets, sellers rushing in on green days, buyers stepping up on dips, a debate brewing between silver's volatility and platinum's quiet moves, and the ever-present backdrop of geopolitical tension that makes people want real things again. If this turns into a sustained move higher, you'll likely see a few things. You'll see dips get bought without hesitation. You'll see premiums stay stubborn. You'll see the sell flood on green days start to weaken. And you'll see the shelf stay thin, not because supply vanishes, but because throughput stays relentless. If that happens, the base gets stronger. And when a base gets stronger, moves can happen fast. But if you don't see those things, if every bounce gets sold hard, if premiums collapse, if shops start getting flooded with inventory and demand cools, then you're looking at a different story. So don't marry a chart, don't marry a headline, marry a process. And keep your eyes on what people are doing, not just what they're saying. All right, that's it for today. And just to keep it clear and honest, this is for education and perspective, not financial advice. I'm sharing how I think about these markets, but your situation is your situation. So make decisions that fit your risk and your goals.